When share markets are falling, how many times have you heard your super provider or your financial advisor say to you, don't worry about it, you haven't lost anything unless you sell it for less than what you paid for, just sit tight, ride it out and let market do its thing. Now, I'm not saying that time is not an important factor when investing and building long-term wealth. It is. My point is, if time is your only means of managing investment risk, what are you paying for? And my second point to you is this. I'm going to show you two portfolios. Now, portfolio one starts with $500,000 in year one, and we're going to invest this $500,000 over a 10-year period. We're going to pull out $20,000 a year to live and supplement our income, and we're going to average a 7% return over a 10-year period. Now remember, I said average 7% return, but we never get 7 plus 7 plus 7. Share-based investing just simply does not work that way. So in year one, we're going to get plus 19, then we're going to get plus 11, come right down to year 9 and 10, and we're going to get some minus 12s, minus 15 to finish off the 10-year period, but we're averaging 7%. And you'll see that at the end of that 10-year period, you're ending up with a balance of just over $626,000. Not a bad result at all. Now, portfolio 2 looks identical. If we're going to start with 500,000, we're going to pull out 20,000, the exact same, and we're going to get the exact same return. Average 7% per year over 10 years. The only difference now is I'm going to flip the order in which we get the return. So rather than start with the plus 19, plus 11, we're going to start with the negatives, minus 12, minus 15, and we'll finish with the positives at the end of the 10-year period. And you can see the balance is very different. We're talking about a balance now of just over $465,000. Now, it's a massive difference. So in the beginning, we've taken a hit because of returns. We're still pulling out money to live on. So we're trying to chase back not only what we're spending, but also get back what we've lost before we can go on and start to make a profit. So my point to you is this: capital losses matter. And unfortunately, a lot of superannuation funds out there will invest your money across a default asset allocation. So they'll put a little bit in shares, a bit in properties, a bit in cash and bonds, and they kind of leave it there and let time do its thing for you. It's what the industry refers to as strategic asset allocation. In other words, we're very well diversified, and we're going to have enough time for markets just to ride out the highs and lows. But it's a very outdated, lazy and inappropriate way to invest your money in many circumstances. You do need to be managing your portfolio on a daily basis. The biggest contributor to your return is going to be asset allocation. Okay? So you want to be buying when the market's low, you want to be selling when it's high. In other words, when value is present, okay? Not just set and forget. To find out more, tailoredwealth.com.au.